Most systems don't fail by accident. They fail by design. At least, that's what we're usually told. When something stops working in society, we instinctively look for a mistake, a bad policy, a poor decision, a lack of competence. When a public service collapses, when a market becomes unaffordable, or when an entire generation feels locked out of opportunity, the explanation is almost always framed the same way: mismanagement, bad incentives, unforeseen consequences. The implication is comforting. It suggests the system is fundamentally sound, that something went wrong along the way, but with the right fix, the right reform, or the right leadership, everything could work as intended. But what if that story is incomplete? What if some systems don't fail because they're broken, but because they're doing exactly what they were built to do? That idea is uncomfortable because it forces us to question something deeper than policy mistakes. It challenges the assumption that inefficiency is accidental, that collapse is a surprise, and that the people in charge are simply trying and failing to make things work. If that assumption falls apart, then so does the idea that better management alone can fix everything. When we look closely at modern economic systems, a pattern starts to emerge. The same problems repeat across countries, across political parties, across decades. Housing becomes unaffordable. Education becomes debt financed. Healthcare becomes complex and expensive. Financial crises keep returning, even after they're supposedly solved. Yet at the same time, certain outcomes remain remarkably consistent. Wealth concentrates, assets inflate, risk is shifted downward, and specific groups continue to benefit, even when the system is described as not working. That's where the contradiction appears. If the system is failing, why are the same winners emerging every time? If outcomes are accidental, why do they follow such a predictable pattern? At some point, repetition stops looking like coincidence. It starts looking like design. So the real question becomes this: are these systems actually failing? Or are they succeeding, just not for the people they claim to serve? Because a system doesn't have to work for everyone to be considered successful. It only has to reliably deliver outcomes for those with the power to preserve it. Housing is almost always described as a broken system. Across the developed world, the symptoms look the same. Prices rise faster than wages, rent absorbs a growing share of income, and entire generations delay milestones that used to be considered normal. Buying a home, starting a family, moving to where opportunity exists. The standard explanation is familiar. There isn't enough supply. Regulation is too restrictive. Demand outpaced construction. And on the surface, that explanation sounds reasonable. Housing is physical, land is finite, and cities can only grow so fast. But explanations matter less than outcomes. Because when we look at who actually benefits from high housing prices, the picture changes. Homeowners, especially those who bought early, have seen enormous wealth gains. In many countries, Housing appreciation has outpaced income growth for decades, not through productivity, not through innovation, but through asset inflation. Banks benefit as well. A mortgage isn't just a loan, it's a multi decade revenue stream. Interest payments compound quietly over time, turning basic shelter into one of the most reliable profit engines in the financial system. Local governments benefit too. Rising property values expand tax bases without raising rates. Public budgets become increasingly dependent on ever higher prices, creating an incentive to protect the system rather than reform it. And then there are investors. Housing has become a politically protected asset class, scarce, inflation linked, and structurally supported by policy. From that perspective, high prices are not a failure, they're a feature. Because the system is not designed to maximize access, it's designed to preserve value. This is why reforms tend to stall. Governments talk about affordability, but act carefully when prices begin to fall. A meaningful decline would erase paper wealth, it would destabilize balance sheets, and it would upset voters who already made it in. So instead, the system manages decline at the margins: small subsidies, temporary tax credits, incremental zoning changes. Enough to signal concern, not enough to threaten outcomes. What looks like dysfunction is actually equilibrium, a balance between political risk, financial stability, and asset protection. Housing prices aren't disconnected from policy, they are policy. Which explains something important. If housing were truly broken, we would expect sustained pressure to fix it. But instead, we see decades of discussion and remarkably little structural change. Because for those already inside the system, it works extremely well. And that raises a deeper question. If shelter, a basic human need, has been transformed into a primary vehicle for wealth accumulation, what does that mean for everyone else? Higher education is usually described as being in crisis. Student debt is at record levels, tuition rises faster than inflation, and graduates are increasingly unsure whether their degrees will ever pay off. For individuals, this absolutely feels like failure. But once again, outcomes tell a different story. Universities continue to expand. Administrative staff grows faster than teaching staff. Campuses become more elaborate, and endowments reach historic highs. From the institution's perspective, the system is remarkably stable. That stability comes from a simple shift in risk. Decades ago, education was treated as a public investment. Governments absorbed much of the cost, and the risk that a degree might not translate into higher income was spread across society. Today, that risk has been privatized. Students finance their own credentials, they take on long term debt, and they bet that future labor markets will reward them for it. If the bet works, the system claims success. If it doesn't, the individual absorbs the loss. Universities get paid either way. This is why tuition can keep rising without immediate consequences. Demand is sustained not by outcomes, but by social expectation. A degree isn't just an education, it's a signal, a requirement to even enter large parts of the labor market. So students don't ask, is this priced efficiently? They ask, what happens if I don't do this? That question locks the system in place. Credential inflation follows naturally. Jobs that once required training now require degrees. Degrees that once guaranteed opportunity now merely grant access to competition. And as credentials lose signaling power, institutions respond not by lowering prices, but by adding more layers, more programs, more certifications, more specialization. Complexity increases, costs rise, and the debt burden grows quietly in the background. From the outside, it looks unsustainable. From the inside, it's extremely rational. Risk has been shifted downward. Revenue is predictable. And institutional survival is no longer tied to graduate outcomes, but to enrollment volume and financing availability. Once again, the system appears broken. But incentives are functioning exactly as designed. Healthcare is almost always described as inefficient. Too expensive, too bureaucratic, too slow. Waiting lists grow, paperwork multiplies, and outcomes vary dramatically depending on income and geography. From a patient's perspective, the system feels broken. But once again, we need to look at who benefits. Pharmaceutical companies remain consistently profitable. Insurance intermediaries extract predictable margins, and administrative layers expand year after year. In many systems, complexity itself has become an asset. A simpler system would be cheaper. It would be easier to navigate, and it would be harder to monetize. Complex systems, by contrast, create gatekeepers, billing specialists, compliance experts, legal teams. Only those who understand the maze can move efficiently through it. For everyone else, friction becomes normal. This is why reform is so difficult. Every attempt to simplify threatens existing revenue streams. Every effort to reduce administrative load challenges entrenched professional and corporate interests. So reforms tend to add layers, not remove them. More rules, more reporting, more intermediaries. Each justified as a fix, each making the system harder to unwind. From the outside, this looks like dysfunction. From the inside, it's stability. Costs rise, but revenue becomes more predictable. Access becomes harder, but margins are protected. The system doesn't optimize for health outcomes. It optimizes for continuity. And this pattern is not unique to healthcare. It appears wherever systems grow large enough to develop internal survival logic. Once complexity protects power, simplification becomes a threat. So when policymakers promise to fix healthcare, the real question isn't technical feasibility. It's whether they're willing to dismantle the structures that benefit from the current design. Because without changing who wins, the system will always return to the same outcomes. So when systems repeatedly produce outcomes that most people experience as failure, it's worth asking whether failure is actually the right word. Because failure implies a mistake, an accident, something unintended. But modern economic systems are rarely accidental. They are shaped by incentives, by political constraints, by power. They decide who bears risk, who captures upside, and who is expected to adapt. From that perspective, many systems aren't malfunctioning at all. They're functioning exactly as designed for the people who designed them. Housing doesn't stay expensive by mistake. Healthcare doesn't stay complex by accident. Education doesn't shift risk onto individuals unintentionally. These outcomes persist because they create beneficiaries with the power to preserve them. That's why reform is so difficult. Not because solutions don't exist, but because solutions threaten existing advantages. This reframes a lot of modern frustration. When people say the economy isn't working for them, it's not necessarily because they misunderstood the system. It may be because they're not the intended beneficiary. And that leads to a more uncomfortable conclusion. Fixing these systems isn't primarily a technical challenge, it's a political one. Because once enough people stop believing the system works for them, they stop asking for optimization. They start demanding replacement. And historically, that's where real instability begins. So the next time you hear that a system is broken, ask a different question. Not whether it works, but who it works for.